Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. On the global markets, a very bullish event, I think, that hasn't really been broadcast that much by financial analysts, economists, and that is the Bank of Japan. It was the first meeting of the new BOJ governor, Ueda, and there was a lot of concern maybe that he would roll back the massive quantitative easing that had been undertaken by his predecessor, Kuroda, over the last 10 years. Were that to have happened, it would have obviously impacted global liquidity expansion, maybe a repatriation of funds back to Japan, which would have involved the sale of bonds in global markets, most notably the US Treasury bonds. So far at least, no change to the BOJ's yield curve control, and that is good for global liquidity and for global markets. The bank crisis also appears to be retreating. A couple of notable comments from big asset managers, gurus in the global market, saying that they think that the worst is behind us, that enough has been done by the authorities to ring fence the problem. So that is good news. And then last week, of course, probably most people missed it, already running off to the Easter weekends, was the US Nonfarm Payrolls. So the first segment, the employment report, the Nonfarm Payroll from the States, there was a 236,000 gain in non-farm payrolls in March, which is pretty good. I think under normal circumstances, we'd be very happy with that. It definitely doesn't seem recessionary, but it is the smallest monthly gain in a year and a half. In fact, 2.5 years, since December 2020. Also, and I think the encouraging part of that is that maybe there's some disinflation on the way in terms of wage growth. And wage growth is always the stickiest part of the inflation puzzle and the bit that most worries the central banks. Weekly hours worked continued their recent downtrend, falling back to 34.4 hours. A downward trend also in job openings and quits, which suggests that labour market conditions are becoming less tight. Average hourly earnings, this is a really important bit, the annual rate dropped back to a 2-year low. So if we look at some of these last April, average hourly earnings were growing at 5.8% year on year, then 5.5% in May last year, 3 months in a row, 5.4%, then down to 5.1% in September last year. Then below 5 to 4.9% in October, 4.8% in December, 4.4% in January. Last month, February, it went up to 4.6%, and that rattled financial markets a little bit. The good news, you'll be pleased to know that in March, it dropped to 4.2%. So very good news there. In terms of the next segment, Central Bank Watch, a really good research from Capital Economics. Interest rates are everything. The outlook for interest rates is encouraging, definitely far more encouraging than it was a year and a half ago when rates were at zero and all we had to look forward to was that they would go up significantly. We're now very close to the peak in interest rates, and that is good for financial markets. Central banks have been using a two-prong approach, raising interest rates on the one hand, whilst also increasing liquidity on the other hand, to support the banks during this mini bank crisis. Central banks will be watching for evidence that tightening credit conditions are weighing on activity. So this is capital economics here. The US weekly data have shown only a slight reduction in lending so far. So what are the key data points that the Federal Reserve and other central banks will be watching out for to determine how much lending standards are squeezing activity? Well, they'll be looking at the lending rates, the rates that commercial banks are charging their customers. They'll be looking closely at bank lending surveys, business surveys, financial conditions indices, and actual economic activity data. And when will these data points be available? On a weekly basis, some on a monthly, and some also on a quarterly basis. Capital economics say that they will start to see the early effects of recent banking strains when the March data are released in early May. But it won't be until August, when the second quarter bank lending surveys are released, that a fuller picture of the economic effects of banking strains begin to build. And that creates a bit of a timeline, really. They expect the information at that point in August to build a case for the banks to end their tightening cycles and begin to cut interest rates before the end of this year in the US and during 2024 in the UK and the Eurozone. The Bank of Canada left its policy rate unchanged at 4.5% in March. We maintain our view that January's hike in Canada was the last. Meanwhile, we think the Fed has now reached the end of its tightening cycle as well. We expect both the Fed and the Bank of Canada to start cutting rates in September and October, respectively. The Bank of England is very close to reaching the end of its tightening cycle. They expect one more rate hike from the BOE to 4.5%, and then to keep that rate level until 2024 before beginning to cut. The laggard is the ECB, the laggard because it only began raising rates in the second half of 2022. Expect the ECB to hike the deposit rate by a further 100 basis points to a peak of 4%, where it will remain until 2024 before coming down. Emerging markets, they began raising rates far earlier than developed markets, and that makes them much closer to a pivot towards reducing rates. Only a few are still raising rates. Central banks in India, Mexico, and South Africa were the only emerging markets to tighten policy in February and March. Tightening cycles in many emerging markets seems to have come to an end, and we expect several to be cutting policy rates by the end of the year. And you'll be pleased to know that the Bank of Vietnam cut its benchmark rate by 50 basis points just last week. We do have time to discuss the housing segment. So we're beginning now with these weak link economies. It's definitely been a theme for MRB. It's also a theme for absolute strategy research. They say that the economic conditions are looking increasingly difficult for housing. The rising risk of housing-led recessions across the global economy, the combination of high inflation, rising interest rates, and tightening lending conditions. And they've got a very nice graph showing the housing downturn risk for different countries around the world. The lowest risk, the Eurozone countries, and that's because households deleveraged in the 12 or so years after the global financial crisis. So they are in good health, plus house prices haven't really rocketed as they have in what they call the CANNS economies. That's CANNS, CANNS. And the CANNS stand for Canada, Australia, New Zealand, Norway, and Sweden. So those are the culprits most at risk of a deleveraging recession ensuing from a sharp drop in residential property prices. So just a quick comment, this is also a theme for MRB. What do they have to say about it? Their point of view, and this analysis is mainly about the currencies of those economies. The collapse of SVB and Credit Suisse have highlighted the vulnerabilities that exist as interest rates are normalized. House prices year over year are contracting for most of these weak link economies at a point where household debt to disposable income remains historically elevated and debt service costs are soaring or will shortly. Higher than expected interest rates will inevitably lead to a deleveraging cycle. So stay clear of those markets and those currencies.
Just a few things that happened over Easter. Nothing happened in the business world, but in the socio-political news, a few things happened. On Wednesday, the 5th April last week, government announced the end of the electricity state of disaster. So the state of disaster is over, no more of that. And also on Wednesday, the finance minister, Enoch Gondongwana, he withdrew Eskom's exemption from disclosing irregular, fruitless and wasteful expenditure. And on Thursday, the next day, the Minister of Electricity warned that phase 8 or even phase 10 load shedding is possible this winter. It's not good news at all. And on Good Friday, the Department of Justice confirmed that its request to extradite the Gupta brothers from the UAE has failed. Yesterday, I think it actually happened long ago, but it was confirmed yesterday that the SA Post Office is actually in provisional liquidation for they owe their creditors 4.4 billion rand. The president is expected to announce a new 5-year investment drive. His original one is behind now, and this has got a new one, and the new target is 2 trillion rand that they want to get in. The news from Glencore, we own Glencore. Glencore put in an offer to buy a company called Teck. It's nothing to do with high tech. You spell it T-E-C-K. It's a Canadian mining company. They mine coal, copper and zinc. The offer was $23 billion, but it was rejected by Teck. And yesterday, Glencore has returned with an amended offer for a combination of cash and shares. It's a bit technical, but Glencore says they won't break their balance sheet to do this offer. The present offer, the new offer is $29 billion. It's a massive offer, massive deal. If it goes through, it will be the 4th biggest mining buyout in history. Then second is Anglo's. They own De Beers and the rough diamond sales for cycle 3, which is this month, was $540 million. It's up from the previous month where those sales were $497 million. They normally try to be above $500 million, and the CEO is very satisfied with this 3rd cycle.